Hello everyone, this is Ryan with Numbers Up Finance, and today I just want to do a very quick long-term SPY video, cover just one big thing that matters a lot to me in the long term, should matter to a lot of traders. It's Monday, March 18th, 2019. Market doesn't open for about 2 hours or so, so we're just going to hop into it and make this pretty quick. I'm not going to do any fundamental analysis, not even going to do much technical analysis. I'm not going to give cases for the bull or bear market. All I'm giving is a simple objective setup long term and something to consider if you're on the fence about either side and you're messing around with long-term investments and you want to make sure you make the most out of them, avoid loss, minimize loss, and maximize gain. So all I'm going to take a look at is the long-term charts of SPY. These are the weekly charts over basically 20 years or so, covering, encompassing each bull and bear market over the last 20 years. And first thing I just want to hop into is the current resistance level we're at right now. This is the 281 top. For anyone trading right now, you know how important this level is. We're trading at around 281.30 right now, and we've been tugging at it for the last 2 weeks. For a swing trader, it's pretty frustrating, and for a long-term investor, I think it can be misleading. We haven't taken out with conviction yet. We have to see it being taken out with conviction to change the sentiment long-term. I don't know if we're going to pop it entirely. If we do pop it, then it's something to it's something to consider long-term, perhaps changing things up. But I want to interpret this 281 price point in the longer picture, not necessarily as a resistance, but as a stop loss for a longer term setup. We have not taken it out with conviction yet, and until we get a weekly close and we park a candlestick above this line with conviction, then I'm still on the boat for a third corrective wave to come. Again, we have those bear market waves coming. I mean, we have the first wave down, we have a bear market rally, and then we follow it with a stronger wave down. I think we're on the point right now. Again, you have to do your own technical and fundamental analysis to come up with your own standpoint. But if you're on the fence and you want a factor to consider going forward, I just want to cover that here today. So let's interpret this level. Let's watch this line, 281 around. It's this top point, give or take. It's not to a T right now. It's the longer term chart. So let's consider that. Let's consider the significance of that. And now let's take a look at what I want to get into, and that's a longer term target for the market and why that matters so much in making a decision right now. So here I have a retracement level set up. This is from the 2007 bull market highs down to the 2009 bear market lows, bull market lows, start of the next bull market. Basically, retracement levels measure how much the next move up retraces the previous high. And as you can see here, our 2009 to 2019 bear market retraced the 2003 to 2007 bull market much more than 100%. We're pushing those 261.8 fib levels pretty strongly. Didn't test them, which I think is significant in the long run should we keep going up. I'll get into that in a little bit. But yeah, I mean, for anyone that doesn't really follow Fibonacci levels, all you need to know is that there's so many reactions along these points, with the 161.8 level being the most significant, I believe. So many reactions. We're talking about 4 weekly reactions or long-term reactions at this point. And you can just see them explicitly here. So these are our retracement levels, and now what I want to do is I just want to run a quick extension, Fibonacci extension for the wave down we had at the end of 2018. And basically an extension will give you price targets for a move down that you don't have. So I want to say, okay, I don't think this is the end of the wave down. I want to extend the first wave down we had so I can get price targets for it. And, this is how it looks. So we again see 1, 2, 3, big wave down. And now, I'm not going to give formal price targets in this video. I just want to cover the most significant one, and that is about 212 for SPY. And why is that significant? Well, there's a fib cluster forming there. There's a retracement level along with an extension level forming there. And even if you don't use Fibonacci levels, you can just see intuitively that this is a significant point. There's been so many reactions along SPY. It's more significant than the 281 point we're at right now. There's been so many long-term reactions. So 212, without any hint of doubt, is a significant point. And I'll just say with 100% conviction, I'm going to get rid of these levels. I'll say with full conviction that if this market is entering the third wave down, not saying it is right now, I'm not saying it's not, but if it is to enter a third wave down, this target will most definitely be tested. Now, of course, anything can happen in the market. Nothing is certain whatsoever, but I will say with full conviction that I believe it will be tested in the next wave down, which I think is coming nonetheless. So why is that important? Well, actually, why am I think that's going to be tested first? So do Fibonacci extensions have any validity in the long run? Well, let's take a look. I want to highlight that. So let's take a look at a Fibonacci extension in the last last recession. Let's look at the 2000 recession, actually. Let's back test these. So let's take a Fibonacci extension that we just did. Let's do it back at the dot-com bubble bear market. So all we do, again, we'll just run this one more time. We run from high to low of our first wave down back to the high of the bull market in 2000, and we get price points. And here are our extension levels for the first wave down in 2000. So if you saw this move back in 2000, you saw this first, let's take a look here. You saw that first about 26% move down, and you thought, okay, I think we're going to have more downside after this. You know, we had a little bear market rally here, and you were at this point and you thought, no, it's not over yet. We're going to have much more downside. Well, you would have ran an extension from this point, and you would have gotten price targets in the future. And in very simple terms, again, it's not this easy, but in very simple terms, your first target would have been 38.2, and then 50, and then 61.8. And as you can see, all of these points were hit, and all these points had explicit reactions from the market. 161.8 was hit. That was your final target that was hit. Obviously, there's more than that. There's a 200% target. There's a 261.8 target, but it's pretty ambitious to set a 261.8 target. That's something you'd have to set longer term, you know, if the market just it doesn't show any sign of momentum change. But in the long term, it was feasible to have this SPY target of 82 set up at 61.8. Extensions have validity in the long term. They're targets that mean something, that have reactions, and the same way they had a significant reaction and had validity in 2000 is the same way they have validity right now, on the verge of a potential recession in 2019. So that is our significant level. Our extension, it has validity, it has a cluster with a retracement from the last market, and it has reactions. So that being said, that point has validity. That point is something we should consider. That point is something we need to watch for. What does that mean? Well, if you're torn on a longer-term setup, if you're torn to enter short, you're torn to enter long, you don't necessarily know where the market's going, consider this, and I'll make this super quick. I'll make it straightforward. Consider risk-reward. If we break 281 and close above that 281 price point level, then things look different. I mean, the bear market case is no longer as intact as it usually is. It still exists nonetheless, but it's not as strong as it has been. But if we close above that level, that happens. We have not had a weekly close above that level yet. A park, rather. I want to see an open and a close above that level to show, okay, we're moving up. The market's pushing towards higher highs. We're not just having intra-week pops above that resistance level. I need to see a strong takeout of that point. Hasn't happened yet. So if we set up a hypothetical long-term scenario here where we, short the market, let's say. We just set up a shorting account, short the market long-term. Here's what I see. You could set around, at most, a 1% stop loss. Because if we close above 284 and we hit that point and we take it out with conviction, 284 is going to be, if we hit 284 on SPY, it's essentially changing sentiment. So 284 is about 1% from where we're at now. 1% is on SPY, especially if you're going triple leverage long term or VIX or whatever you're doing. That will matter, but in the bigger picture, that's really not that much money, especially for a long-term investor. So 1% stop loss in the market is feasible by all accounts. Now, what's the reward? Well, if we take that price point, and this is just one of the targets. There are more targets beyond this point, but if you take this, very, very high probable target down here, you see about 24%. And just for simplicity, we'll say 25%. Obviously, it doesn't work like that, but I just want to make things as straightforward as possible. So that means if we have a feasible 1% stop loss, which, again, is marked by a break above this significant resistance point, and a 25% room for downside, which, again, is marked by an extension point and a fib cluster and a point of reaction in the longer term, that sets us up with a longer-term risk-reward of 25 to 1. And for any trader, that is astronomically favorable. That is something that you cannot just neglect. That is something you need to consider, especially if you're torn on what to do with your long-term investments. Now, listen, there's a ton of things you have to do to figure out, okay, what do I want to do with my money long-term? Bear market, bull market, you don't really know. You don't have to short the market long-term. That being said, it might be feasible to put your long-term investments on hold right now and say, okay, if we get a break of this level, then I'll consider getting back into my long-term investments. But if we're still failing to take out this level with conviction, then, and we start to get confirmation that in the bigger picture we're going down and more downside, then why not set up a long-term risk-reward setup? The risk-reward will be high and favorable for a while. I mean, even if you set a 5% stop loss, that's still a 5-to-1 risk-reward ratio for a long-term trade. A very long-term trade, mind you. So again, that's just something you need to point out that I wanted to point out, and it's been glaring to me for the last couple weeks now. And again, with those corrective phases typically happening in wave 1, wave 2, and then wave 3, this could be the tip of the iceberg. The market's been so resilient, I understand, but consider that 25-to-1 risk-reward ratio, and maybe it's even 50-to-1. Like, you could set a 0.5% stop loss and get away with it right now. Last thing I want to cover then is, okay, let's run that scenario A. Is we set up a 50-to-1, 25-to-1 risk-reward ratio, stop loss above this trend, this resistance point, and it plays out and we go and test this target. That's favorable scenario. That's the one I favor, frankly, and it's scenario A. Let's take a look at scenario B. Is we break this trend line, we close above it with conviction, and now we're not really quite sure what to do in the long run because we think, we don't necessarily know where the market's going now, but at the same time, the market's been overextended. So how do you feel comfortable getting into long-term investments at the tail end of a bull market? Because even if the recession doesn't come now, it's going to come in relatively short term. We've had a 10-year bull market going. Just cyclical economics will tell you that we're overdue for a correction. What do you do? Well, this 301 price point to me is the same deal. We get to that point, and if we start to see notable reactions, again, this is a Fibonacci retracement. Fibonacci retracement levels have clear reactions. Every single one of them gets tested along the way, mind you. We get to that 301 price point, we take out 2018 highs, and we get there and we start to see a reaction. Same deal. Set up a long-term trade, or set up a long-term risk-reward. We're parked at 300, let's say, in this hypothetical scenario. Set a 1% loss above this retracement level. And then from there, we still have every right to go down and test those 212 levels. So at that point, you're looking at a 40% correction. Obviously, this isn't my favorable scenario, and it's not as black and white as that. But, if we're going to break the 2018 highs, the most feasible point for a reaction that I will see is 301, because that's our next Fibonacci retracement level. Now, if we take out 301, that's a whole nother discussion to have. We need to consider so many other things. And like I said at the beginning of this video, I'm not getting into technical and fundamental analysis of the bigger picture. All I want to do is just point out these price points to anyone who's torn about long-term investments, torn about where the market's headed. So if you're not quite sure where to go, or you're on the fence about either side, maybe this weighs into the bearish factor. Or maybe this just bears into sitting on your hands. It gives into sitting on your hands for a little bit. Because, again, if we get that 1-2% pop above 281 and the market shows signs of going up, then, consider getting back on the bullish side of things. But in the meantime, the expected value of getting into a long-term trade right now, or even holding your longer-term investments, is just so low. There's so little upside to it, and there's so much upside to getting into a short, and it would just be negligible to act like it's not there. So that's what I wanted to point out. So many things to consider. I'm looking forward to this week. I'm looking forward to the close we'll get. Again, make sure you do your own technical and fundamental analysis. Watch for a break above that 281 level, a close above 281 with conviction, and then keep an eye on that 301 level looking down the road if we decide to go test it. So, that being said, that's what I wanted to take a look at. We'll have more long-term videos coming. We'll have daily market analysis videos to keep you guys posted on how we see the market headed. And if we don't break that 281 price point, keep an eye out for that next wave down. Of course, we got to take the market day by day, but we'll see where it decides to go going forward. So, anyway, this has been Ryan with Numbers Up Finance.